Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In Part 2, we'll continue looking at high-risk financial services, including shadow banking apps, synthetic assets, and liquidity traps that can lock your money when you need it most. Zero legal protection for users. When a service avoids registration and oversight, it usually means you lose the safety rails people assume they have. If the app isn't registered with regulators, in the US that often involves the SEC or state agencies depending on the product, you shouldn't expect standard protections. Your deposits are not insured in the way bank deposits are. You may not have clear custody rights. You may not even be a recognized customer under any enforceable agreement. If the app breaks, gets hacked, or shuts down, the support chat won't matter. Without a regulated framework and a real legal entity in your jurisdiction, you can end up with a loss that's final. That's why unregulated AI trading bots and many decentralized auto traders belong on the 2026 Do Not Invest list. Shadow banking and synthetic asset platforms. Another gray zone in 2026 is the rise of platforms that act like banks without following banking rules. They may offer earn accounts, instant loans, high yields, and debit-like tools. The interface can look like a modern bank app, but the legal structure behind it often looks nothing like a bank. These services may pool customer funds, lend them out, stake them, or use them as trading collateral. The yield can be real for a while, but the risk can be hidden. If the platform isn't a bank, you can't assume bank-style supervision, capital rules, or consumer protections apply. Synthetic asset platforms add another twist. A synthetic asset is a token designed to track the price of something else, like a share of a public company. You get price exposure without owning the underlying stock. On paper, it sounds convenient, like buying a shadow copy of a share. The problem is that convenience often comes from bypassing the normal market structure, and regulators pay close attention to that. Why synthetic assets are under fire. In 2026, mirror versions of stocks remain a hot target for regulators because they can blur lines between a token and a security. Traditional stock markets have rules for listing, disclosures, trading venues, and market surveillance. Synthetic versions can sidestep parts of that system, even when they look and behave like the real thing. That creates two risks for you as an investor. Sudden access risk. A platform can delist synthetic stocks fast if it fears enforcement, banking pressure, or exchange takedowns. Your position can become hard to close at a fair price. Legal classification risk. If regulators decide a product should have been treated as a regulated security offering, platforms may restrict U.S. users, freeze features, or demand rushed identity checks. None of that helps when you just want to exit. When the rules of the road aren't settled, your investment can turn into a hot potato no one wants to hold. The biggest lesson for investors in 2026 is simple. Choose clarity over hype. Demand transparency, real oversight, and clear rules before trusting any platform with your money. Thanks for watching, and we'll see you in the next video. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.